Hey, it is May the 11th. It's 2 p.m. Pacific Standard Time. And you know what time that means it is? It is time for Mortgage Minute. Hi, my name is Jeff Harrison. I am the guy behind the scenes, and our host is just putting a little powder on his nose. He should be ready in just a few minutes, but he's got a great show lined up. I've seen the inside track of his presentation today, and there's some great information. It's really, it's kind of tingly. It's some good news, a lot of good news about the economy, especially for those of you thinking about, well, should I refinance my house? Should I buy a new house? Maybe I should buy some condos. Today, he's going to answer some of those questions. Speaking of answering questions, if you are watching today or you're watching this and it's not live, you weren't able to be here live, this is a live interactive show. As his saying goes, with MortgageWorks, the company that Art owns, is the answers. He has the answers and they're on the house. So he wants you to make sure that you put your questions in the Q&A and he will answer those. By the way, if you have a question as we're going along, I'll be behind the scenes and I'll be watching for those, and I will make sure that Art answers those questions. So make sure to stay with us. And again, just put those in the chat. So let's bring Art in. I think I see, yep, I see the green room is ready to go. Here we goes. Hey, Art, welcome.
Hi, Jeff. How are you?
Wow, I've got to get a hold of your makeup person because you look fabulous.
My nose has been powdered. Yep.
You look great. Hey, anything I need to know before I duck out of here and start running these slides behind the scene?
No, I think you did a pretty good job with the intro there, Jeff. Yes, I think I've got some pretty good information that I think will be of interest to our viewers. And yes, that's a pun intended. So,
all right, fantastic. Have a great show. I'll be behind the scenes.
Okay, thanks, Jeff. Well, hello everyone to this week's Mortgage Minute. So let's go ahead and just jump right into it. The first thing is, as we usually try to start out with, is like what's going on in the markets, in particular the bond market, and where's mortgage rates this week. So here, starting off, what we're going to do is pull up a chart of the 10-year bond yield. As you certainly know by now, that's sort of my favorite go-to for reading mortgage rate trends. And there you can see the chart. And this is a 5-day chart of the 10-year bond yield. And as you can see, it was actually fairly low a week ago, last Friday, and then it climbed up midweek. And then, as you can see there toward the end on the right side, a nice trending downward in the yield. So we're at this point for today, the 10-year bond yield once again broke through the 3.4 level. It's at 3.39. Now that bodes well for mortgage rates. So in fact, as you know, we have on our website a rate grid that we try to keep posted all the time with rate indications. And so if you go back again to our website and look at the rates, there you can see, as I pointed out last week, mortgage rates are actually hanging in there pretty well. We're basically, for conforming loans, it's a market that's in the fives, for FHA, VA, Fannie Mae, Freddie Mac. And then, of course, when you look at those kind of note rates, that creates a great opportunity for those temporary buy downs where you can get a 3-2-1 starting in the twos or a 2-1 starting in the threes. So what's going on? What has caused the bond yield to drop a little bit? And why is it the rates are continuing to hang in there, being pretty favorable and pretty stable? Well, the big economic news this week was two things. First, the CPI, the Consumer Price Index, that actually came out yesterday, Wednesday, May 10th. And then today, the PPI, that's the Producer Price Index, was released. Now, the CPI is sort of the retail level of inflation. And actually, that number, when it came out yesterday, was better. It trended downward again for the month of April. It was 0.4%. On an annualized basis, 4.9. So that got us on the CPI level below 5%. Remember, not too many months ago, we were basically above 9. So that's certainly good news from the inflation front. Today's PPI number, similar news, 0.20 rise in the PPI in April. That's 2.3% annualized. That was slightly better than expected as well. And then the last economic data that came out today was jobless claims, initial claims for unemployment. Well, today that number, 246,000, that was slightly higher than anticipated. So when you look at these, the CPI, PPI, those are giving us a signal that inflation continues to improve. That's good news for the bond market. That helps, reassure the bond markets and helps keep those yields lower. And then the jobless claims, A little bit of a surprise there. Part of the issue for the Fed is watching the job market. It's been pretty tight. So this is a little bit of a signal that maybe the job market's loosening up a little bit. And if that's true, that's also reassuring to the bond markets. So that's another reason why we've got the mortgage rates where they're at. And so just, that should be encouraging for everyone, whether you're still, tracking rates to decide on a refinance or to maybe look at a purchase loan here pretty soon. Now, going into the next thing I want to talk about, yet again, I've got another update on this, as I call it, raging controversy related to the credit score LLPAs that were announced to go into effect May 1st. Well, what kind of flew under the radar is part of that change didn't just include LLPAs for credit scores being changed, raising them a little bit for higher credit scores, lowering them a little bit for lower credit scores. Another factor or another component of this change was to be an increase or an LLPA charge for debt ratios over 40%. Now, that was actually the provision out of this entire group of changes that caught industry attention almost immediately. And so there was a lot of pushback in terms of getting rid of this or frankly, eliminating the requirement altogether. And so initially, this change was pushed back from May 1 to August 1. That was still a concern, of course. But then out of the blue, really kind of, yesterday, May 10th, the Federal Housing Finance Agency issued a bulletin where they have rescinded the LLPA for debt ratios over 40% effective immediately. So as of May 10th, that's when the announcement was issued. And so as a consequence, we can not worry. There's the announcement right there. We don't have to worry about implementation of that particular LLPA. Now, why is that important? Well, one of the things the industry pointed out is that to try to manage that component, that type of LLPA would be very problematic for lenders just by nature of the process of processing a loan application, submitting it to underwriting, and getting it closed. Throughout that process, there can be changes to the debt ratio for the file once it flows from the originator, who may have come up with a certain debt ratio that they're using for purposes of maybe executing a rate lock righted application. But then you've got the process of the lender and their underwriting staff reviewing all the documentation, the income documentation, of course, in particular, and they may calculate a slightly different debt ratio. And what if that suddenly pushes it over 40 when the loan was already locked based on the originator's calculated debt to income ratio before the file was registered? So it could create a lot of havoc in terms of tracking that debt ratio if it's hovering above or below 40. And so just from a practical standpoint, it just didn't make a whole lot of sense to be able to implement that cleanly. So thankfully, the regulators heard the pushback, and that has been rescinded. So we don't have to worry about anything along those lines going forward, at least not for now. So now on the next thing I want to talk about, and if you recall last week's program, we left you with a closing question. And so I want to kind of cover that now because I think you're going to be interested in what the reply or what the answer is to this question. Remember, as a reminder, the question was: a borrower with a 655 credit score has been pre-qualified for an FHA loan and would like to purchase a lower priced condo. Will the borrower be able to do so if the condo development that the person is interested in is not FHA approved or not on the FHA approved list? Well, guess what? The answer is definite maybe. Now, I'm being a little funny there, but the point is there is a potential option for this scenario, and it's called the FHA Single Unit Approval, or SUA. Now, what does this entail? Well, what it involves is the ability to get an individual condominium unit that's located in a condominium subdivision that's not already on the FHA approved list. This is a process whereby we can determine if that individual unit could still be eligible for an FHA loan. Now, in order for that to occur, we have to meet certain criteria, and there's a specific checklist that's used that is a good summary of what conditions the condominium property has to meet to be eligible for a single unit approval loan. So let me go ahead and pull up that checklist just to give you an idea what it looks like. And here it is. And by the way, with regard to this checklist, if you'd like to get a copy, contact me. I'll be happy to send it out to you so you have it for your records. But as you go through it, you're going to see some bullet points of the kind of criteria the condominium development has to meet in order for FHA to potentially approve a transaction for a single unit within the development that's not FHA approved. Now, in this bullet point list, there are certain things that tend to be the biggest or the most important criteria and can usually make or break the deal. Now, the first one that's very important, I would say, is short-term rental. A condominium development cannot have a short-term rental policy that allows less than 30 days short-term rental. So that's very important. Here in the Coachella Valley, there's a decent amount of condominium developments that have short-term rental policies below that. So those ones would not be eligible for this program. But there are still a lot who do allow 30-day rental or more, not less than that. So that would make that development eligible for an FHA SUA loan. Now, the second thing that's very important is occupancy ratio. The condominium development has to demonstrate that at least 50% of the occupants or the owners of the development in total have to be owner occupied. Now, this gets to be a little fuzzy because owner occupied can include second homes. So it's really owner occupied and second homes. And again, a second home is typically a vacation home available for year-round use by the owner, although they can rent it out at times for short-term rental income. So a owner-occupied or second home property is included in the 50% owner-occupied ratio. So what this really means is not more than 50% of the total condominium developments can be leased out to long-term tenants. Now, where it gets tricky is being able to verify this number. Some management companies are a little bit more easy to work with than others in terms of getting the breakdown of owner-occupied and second home in order to meet that 50% ratio. And then the third item on this list that comes up most often in terms of maybe making or breaking the deal is the HOA delinquency rate. For this program, the HOA delinquency rate cannot be more than 15% of the total units in the development. That is, not more than 15% of the units can be more than 60 days delinquent on their HOA dues. So in that regard, these three criteria in particular are usually what we see to keep a deal from getting approved for SUA, or if these three are met, in most cases, subject to also meeting the other items on the list, we can do an FHA SUA loan. And this is a program I'm pretty passionate about. I think it's underutilized. I don't think it's well known by both buyers as well as real estate agents, but it's actually helped us save a transaction in the past. I think I've told a story in past episodes or on some of our videos. I had a lady coming in to the Palm Springs area, moving from Illinois. Her mother lived in Desert Hot Springs. We tried to get her approved for a conforming loan with 5% down, and the Fannie Mae desktop underwriter system would not approve her, even though her debt ratio was very good at 37. So, and she was buying a condo in Palm Springs. So that was a problem because then we had to find a condominium development that would accept FHA or where we could use this SUA option to get the loan approved. And sure enough, we were able to accomplish that. So I was actually able to help the lady, the borrower, get an FHA loan for her purchase, which actually had a better rate than the conventional loan. And we were able to get the SUA approval done on the property. And so she ended up accomplishing her goal of getting home ownership on a condo here in Palm Springs. Now, why would the FHA SUA program, what's the benefits of this? Why would it make sense to go through some of the steps that you have to in terms of meeting the checklist and establishing that the property is going to be available or eligible for an FHA loan? Well, the first thing it does for a home buyer is it expands the potential pool of homes that they can purchase. There's a lot of homeowners, or actually first-time home buyers, who may be at lower credit score levels, who may have determined through talking to someone like me that they need to use an FHA loan in order to get approved, and particularly for a price level that they want. So this program opens up the pool of available homes because there may be more condos available for that buyer to purchase. The other thing about FHA, as I just touched on, is particularly for borrowers who have lower credit scores, or who may be a little bit more challenged in terms of debt to income ratios, FHA is almost always a better loan option than conventional Fannie Mae, Freddie Mac agency loans. Even though those offer a 3% down payment, FHA is almost always going to provide better terms for lower credit score borrowers and borrowers challenged with a little bit higher debt ratios. And the other thing, it's a subtle thing, conforming conventional loans actually consider a condominium property type to be a risky feature. And in fact, if a borrower is going to buy a condo with less than 25% down, Fannie Mae and Freddie Mac have an LLPA for a condo property type of 0.75% of the loan amount. Well, that's about at least an eighth in rate, if not more. Well, FHA loans have no such LLPA for a condo property type. So as a consequence, FHA tends to be, as I would say, more kind to a condo property type. So that combined with the fact that an FHA loan is going to usually give a better rate to the buyer than a conforming conventional loan anyway, that's another reason FHA loans are great for those particular buyers. And if they want to buy a condo, there is a way to solve that issue for them and get them that condo. And then lastly, I would point out that for listing agents, if you're able to do a little bit of the upfront work, determine if your condo that you're listing is going to meet the criteria on the checklist, it would be well worth it to confirm that so that as you market this property, you can open up again the size of your potential market and be able to indicate that FHA may be an option to use by the buyer to successfully complete the purchase of the home. So for all those reasons, I'm a very big fan of the FHA SUA program. I think it's, again, underutilized both by buyers and as well as sellers and real estate agents. So I just want to remind you again of that program. Keep it in mind. If you do want to get a copy of that checklist, just reach out to me. I'll be happy to get you a copy of it. Now, speaking of condos, one of the things I do want to speak on is HOA dues and what I call purchase price power. Now, having just talked about condos and how FHA SUA can be a viable option to help get more buyers into condominium properties, let's talk a little bit about how does HOA dues enter into how much you can qualify for in loan amount. Well, guess what? They're a pretty significant factor. The point of it is that if you're looking at buying a condo with maybe buying a single family home that may not be in a gated community, and so therefore is a single family detached home without HOA dues, you might be surprised at the difference in price power that you may have be able to achieve depending on whether you're looking at a property with HOA dues or not. So I'm going to give you a few examples here. So let's say you have an FHA, you're looking at a condo and the property's got $300 a month in HOA dues. What does that do in terms of diminishing the amount of loan amount that you can qualify for? Well, guess what? It's not an insignificant number. With HOA dues of $300 a month, you're looking at, that's roughly equivalent at current mortgage rates, about $50,000 in loan amount. Take it a step further. What if the HOA dues on the condo you're looking at have $400 a month in HOA dues? Well, that's roughly equivalent to $66,000 in loan amount. $500, more the same. $600, more the same. $100,000 in loan amount is what $600 a month in HOA dues is equivalent to. So consider that. Maybe you're looking at a condominium that's high on the higher end of condos. Maybe it's $4.25, and it's got $600 a month in HOA dues. Well, possibly, maybe in the same market area you're looking at, could you find a single family home that might be priced as high as $5.25, $525,000, $100,000 more, but with no HOA dues? Well, from a qualifying standpoint, it's probably equivalent because you don't have that $600 in HOA dues bleeding off or minimizing or lowering the maximum loan amount you're going to be eligible for. So as it looks, as you're considering properties, ones with HOA dues, ones without, just understand the impact or how much HOA dues factor into what your total housing expense is going to be and how much loan amount you can be eligible to qualify for. So it comes down to cost benefit. You've got to figure out, are the HOA dues that a particular property is going to have is the the benefits and the amenities that you get with those dues. Is that going to be worth it relative to realizing that the maximum loan amount you're going to be eligible for is going to be lower because of those dues? So you just got to keep that in mind as you factor in or consider all of the different options you have for purchasing a home. So with that, I want to go ahead and leave you with our closing question for this week. And it's an interesting one. And that is it possible for a borrower to purchase a rental property with less than a 5% down payment? So, of course, that's the question. You'll have a week to think about it. Tune in next week where we will have the answer, and it will be on the house. And then I also want to leave you with one other thing as it relates to the financial markets, where mortgage rates are, what the Fed did last week. Don't forget about equity lending. If you own a home, you got a lot of equity. You don't want to touch your first mortgage because the rate's so low. A HELOC, I think, is a great thing to look at now. Timing, I don't think, could be any more perfect. We think the Fed's going to pause on raising the Fed funds rate. There's still a lot of equity with most homes. So if you've been mulling a HELOC but haven't moved forward with that and you think you want to, give me a call. I'd be happy to help. So with that, Jeff, back to you. See if we have any questions.
Yeah, I think those are some great points. Thinking about a condo, especially here in the Coachella Valley, and let's face it, there's a lot of pressure on housing as far as a shortage of housing, and so I see a lot of building going on, and I would say the majority is multifamily or condo development. So I think the information you shared today is not only relevant, but it's vital to so many people out there, especially, young families that are just getting started. Maybe it's their first time home buyer, or maybe they're moving to the Valley. Maybe the whole thing with the hockey team and AccuCenter, all that stuff has moved them here to the desert. And this is a great place for them to start. And condo loans are not a bad thing.
Well, they're not. And actually, it's funny you mentioned, because I was at a luncheon with the Desert Valleys Builders Association here locally. And one of the things that was being talked about was, of course, more housing, more affordable housing. Of course, now these days, apparently, affordable housing is not the preferred label. It's kind of transitioning to quality housing for workforce, with the new arena, with some of the other plans in terms of commercial and development and hotels that are coming and so forth. There's more of a need for workforce housing, and there's lots of condos here in the Valley. A lot of them, are attractive because their price levels are lower than single family detached homes, and so that could be a way that we can get more workforce housing for the population here locally, as well as those who would come in to start working at some of these new properties. So, and I think that's why with this FHA SUA program, it's going to help provide another financing option for those buyers who need to stay at that lower price level, and who also need the more flexible underwriting guidelines and the more attractive FHA rates that are available compared to a conforming conventional agency loan.
One of the questions that came up while you were talking about the qualification, the list of items, and you were highlighting just the ones, you highlighted about 4 of those on there. Does that mean those are the main ones that need to be achieved, or is it do all of those things have to meet it to be an FHA approved?
I mean, yes. When you look at the list, the checklist, everything, the property does have to meet everything on the list. Now, in some cases, you can tell just by looking at the list, some of them are just not going to be applicable, like the very first one, at least 5 units. Well, the reality is most condominium developments are more than 5 units. Although, interestingly, I'm handling a purchase loan for somebody buying a second home up in Big Bear, and he owns a condo in San Francisco. It's a rental property, and it's a 4-unit condo building. But that's the point, is that as you go through the list, all of the bullet points do have to be met as applicable. Because when you read the bullet point list, some of these for a particular development or particular subdivision will not be applicable. Maximum 35% commercial space. Well, a lot of residential commercial subdivisions don't have any commercial space at all. So that would be a not applicable part of the checklist. So yeah, that's the idea, is you start with the total checklist, first determine which of these criteria are not applicable. You can cross those out, then focus on the remaining that are applicable, and then make sure that the development meets this criteria. The reasons I pointed out the ones that you highlighted is these are probably the three primary criteria that will, in most cases, prevent the deal from going forward. I had one, we thought we had it ready to go, but the HOA delinquency rate was literally 17%. Couldn't move forward. We had another one where, we thought it was okay, but we found buried in the CCRs that the condo development allowed 7-day short-term rental, not 30 minimum. And but otherwise, the HOA delinquency rate was fine, the occupancy rate was fine, but the development allowed 7-day rental for short-term rental. That's a deal killer for the SUA program.
It sounds like, and I have one other question on this, but it sounds like these that people can think, well, these could be deal killers or so restrictive. Really, from an investment standpoint, is the lenders are looking out for their long-term investment, and if they do have those short-term or the high delinquency rate, that really diminishes the value of the overall investment. Is that what they're doing there? They're just protecting their assets?
Well, that's exactly right. In fact, actually, it's not really just the lender per se; it's FHA. Remember that how FHA fits into the picture is FHA doesn't make the loan, but what FHA does is it insures the loan for the benefit of the lender, so that if the lender, and because of that insurance, the lender is able to make FHA loans using the I call it more flexible FHA underwriting criteria. FHA loans are generally always priced better. But because of that, FHA has an interest as an agency to make sure that if they're going to deviate from their historical program of a condominium has to be an approved condominium development, one that FHA has approved in advance. This is a way to get around that and still provide more housing. But FHA has an interest to make sure that particular development meets this criteria because, FHA is not interested in guaranteeing a loan for a lender in a condominium development where 1/3 of the unit owners aren't paying their HOA dues. That's a recipe for disaster. So FHA as an agency is going to stay away from that.
One other question is when it comes to seeking out FHA approved condominium programs, is that something they reach out to you and you have a way to say, yes, these qualify, these don't, or is that widely known?
It's not widely known. I think there are some, a good portion. I think real estate agents are aware. I think the general public maybe not so much aware, but FHA does maintain an approved condominium list throughout nationally. So I can access a list, and by city or by county, by county and city, I can pull up a list of approved condominium developments. Again, for all, cities in a particular county. And frankly, I do that quite often here. I mean, I can pull up a list for Palm Springs condos. I can pull up a list for Cathedral City condos, Rancho Mirage condos, and so forth, La Quinta condos. So I can access readily a list. So if anybody is looking for the approved condo list, again, reach out to me. Be happy to send you a copy. But that's also helpful because as a first step, if you're looking at a particular condo subdivision, check with me. I can find out if it's already on the list. If so, you're good. That's good. If not, then we could take the next step and see if that development might meet the SUA criteria so that FHA can still be an option.
That's fantastic. Hey, just the last question was, how do I get that list? I'm just going to pull that up there now, and you can just email Art at art@mwloan.com or call him at the office, 760-883-5700, or you can get a hold of him on his cell at 714-612-9035. And of course, for the latest update on the rates, you just go to mwloan.com. I'm excited every week. It seems like since we began this program, I'm not taking any credit for this, Art, but I've noticed the rates have gotten better and better, and they're real solidly in the 5s, which is really exciting after we hear, they were in the 7s. So well done.
Yeah. I think we're on the right path. I think the trend is looking pretty good.
Good deal. Well, Art, thank you so much. I appreciate it. I know you got to go. But for those of you who are watching, maybe on a recorded, and you have a question or a comment on this, please put it in the question area in the comments, whether it's on YouTube or Facebook, and let us know, and Art will get back with you. In the meantime, have a fantastic week. And if you're ready to take action on a HELOC and you've just been waiting till things kind of calm down, now could be the best time. Give Art a call at 760-883-5700, or you can call him on his bat line. That's 714-612-9035. Art, thank you so much. Have a great week.
Thanks, Jeff. Appreciate it. See you next week, everyone. Just remember, at MortgageWorks, we do have the answers, and they're on the house.